Hello everyone, welcome to this live class on GK, and the first topic we'll be dealing with is Indian economy. Now before we begin the study of economy, we want to understand what this term economy itself means. This will give us a clear insight into why and what we are studying. So this word economy comes from the Greek word oikonomos, which itself can be broken down into oikos and nomos. Oikos means household, and nomos means to distribute. Therefore, we can understand that economics is about distribution or management of all the wealth that is generated in a nation. So, the first book, the beginning of economics, as we all know, as we have heard, begins with this book, An Enquiry into the nature and causes of the wealth of nations. In short, this is also known as wealth of nations, and it becomes a very important GK question. It was written by Scottish moral philosopher Adam Smith. Remember, I called him a moral philosopher. Economics, as we know it today, was not in prevalence at that point of time. So he was basically a moral philosopher, and capitalism, this term, this phenomena, more than being an economic philosophy, it is a moral philosophy. Why so? Why do we say so? Is because of its maxim that says greed is good. Now, as we proceed, we will see why this was said, how this was said, for what prevailing circumstances and reasons this was said. But before that, one more important thing that we should know before we begin our study is that any model, any framework, any subject, it defines certain things, and it is in that framework that we try to study that thing. Anything becomes meaningful when we narrow it down, and try to define it in meaningful terms. So, you must also know this quote by Peter Drucker, a management guru, a management expert, who says, what can be measured can be managed. A very simple way to understand this is that when you are preparing for any competitive exam, what you do is you give a number of mock tests and you try to measure your performance, measure your score, and based on that, you try to make an improvement. Similarly, in case of an economy, we measure various indicators like GDP, GNP, HDI, and by measuring these, we try to assess where the economy and its people stand and thereby make further improvements. So these are some fundamental concepts that you should know before proceeding. So the central problems of an economy are mainly these three: what to produce, as you can see, necessities or luxuries. Now, there is a difference between wants versus needs. And any want or need only becomes demand when it is backed by purchasing power. Many of you might want a big car, a very good mobile phone, or something like that. But unless you have the power to purchase it, unless you possess the money, it can't be said to be the demand for that product. Here, there are again two important terms that can be part of your exam. One is giffen goods, and another one is Veblen goods. Now, giffen goods and Veblen goods are two exceptions to the law of demand. Giffen goods are those goods, or even before that, what does the law of demand states? The law of demand states that as the price of any good increases, the customers will demand it less. So it is a downward sloping graph. Now, these giffen goods are things that do not follow this. That means if any commodity, its price goes down, then its demand should increase. But giffen goods or inferior quality of goods, are the goods, as you can see in its name, the demand for them will not increase commensurately with their decrease in price. For example, grain or poor quality of grain. So as you must have known this phenomena often in the newspaper, that as the income of people increases, they switch to a more protein rich diet like meat, egg, dairy, and such other things. So there, this giffen good is being displayed. Veblen goods are the opposite or the other end of the spectrum, where these are such luxury goods which people consume in order to display their status. The sociologist Thorstein Veblen, after whom this is named, called it conspicuous consumption. Conspicuous, that means showy. Conspicuous consumption. So now you know, anything like an iPhone or a yacht or such kind of things, if their price increases, the demand for them will not decrease, because the strata that is demanding it and the reason why they are demanding it is for the purpose of show. And these are luxuries, and luxury items, as you know, is demanded by a very small segment of population. Therefore, again, Veblen goods will not follow the law of demand, and therefore we can say that giffen goods and Veblen goods are things that do not follow this law of demand. And finally, or secondly, how to produce. The first problem was what should be produced in the economy, what people are demanding or what people need. We'll see why and how we have reached this conclusion as well. So how to produce something depends on whether it can be labor or capital, labor driven or capital driven, labor intensive or capital intensive. Let's take the example of USA and India. In USA, you would have seen that lot of farming is conducted with the help of big machinery, threshers, and you will not find many human beings working in the field. The reason is that its population is low and it has a large pool of capital resources. Whereas in India, the common sight or the common picture that you might have seen or you might have come across in textbooks is one where a lot of people are involved in planting the seedlings or nurseries of paddy. Now, they do it manually because India is a population, it has a lot of population and low amount of capital. Therefore, this is the method that is followed so that everyone gets a share of whatever is produced. And for whom to produce? Individual purchasing power versus necessities. So this is about which section of the population you are producing things for. Now you might have heard of schemes like Pradhan Mantri Antyodaya Anna Yojana, Garib Kalyan Anna Yojana. So here, people who are below poverty line, they are provided with a lot of grains. Even though they do not have the purchasing power, still these things, the amount of grain that is being produced and procured, that is being done for a large number of population that do not have the adequate purchasing power. So these are the central problems of the economy. Since we know that economy is about household management, and this nation, this country, or any country is a big home of consisting of a lot of people, a large number of people. So also another definition of economy that comes out from this is that it is the study of scarcity. Study of scarcity. What is scarce? Time is scarce, money is scarce, resources, they are scarce commodities. Life itself is valuable because it is limited. You get it for a very limited period of time, and that is the reason what makes life valuable. Any commodity that is in abundance will not command a price on the market. Say for example, air. As of now, we do not need to pay for air, but imagine a scenario where clean, fresh air becomes a very, very scarce commodity. Then you might have seen in some dystopian movies that people are carrying oxygen tanks, air cylinders on their back and breathing through a nozzle. So that will be a situation when air, clean air itself becomes scarce. Water 100 years ago, any of you can imagine, it did not command a price in the market because fresh water was in abundance. But now it does, it is packaged. Why? Because clean, fresh, potable water, that is a scarce commodity. Moving on, we see what are the causes for these economic problems. The first is scarcity of resources. No resource, as I already said, is infinite, and therefore the principle that we derive from this is that people, institutions, firms always face a trade-off. People always face a trade-off. Trade-off means you have to give up something in order to get something. That is a trade-off. Because things are limited, because quantity. A good example of this would be if you are interested in sports or any other activity and you want to play it for 8-10 hours a day, then you have to do it at the cost of your studies. Or if you want to clear a competitive exam, then you will have to manage. You cannot play for all 7-8-10 hours that you get. You will have to give up some time that you play for. Then the other factor that causes economic problems is unlimited human wants. There is no end to wants. As I said, it is only the purchasing power that tones down what you need, what you purchase, what the market will produce. Then every commodity has alternative uses. Say for example, something as simple as wheat is used for making bread at home, and also it is this wheat which is used for pizza. So everything has, because it has alternate use, that is why it is said that there are alternative uses, and this is what engenders the guns versus butter debate. So every year in the nation's budget, there is a discussion about whether the government is increasing its expenditure on defense or is it increasing its expenditure on welfare measures. And there are always critics who say that the government should spend more on eradicating poverty, alleviating different distresses that people are facing rather than increasing the defense budget. But then other people say that national security, that is of prime importance. If that does not remain, all the developmental goals, we go behind on them. That is why this guns versus butter debate. Guns versus butter debate, basically security versus welfare. Every soldier standing on the border, it is said that a soldier is a farmer in uniform. So imagine it is the same money that you are paying soldiers, this resource, the same money you are using to procure guns and ammunitions, it is the same money that could be used to procure more tractors, more seeds, more fertilizers. And therefore, I think by now you must have understood what this guns versus butter debate means. It can also become one of your questions. So do remember this thing. All right. Now let's come back to this capitalist economy. You see, in a capitalist economy, production, the process of production happens by private entrepreneurs. The moment I say it takes place by private entrepreneurs, it tells us a very basic, a very fundamental characteristic of a capitalist economy, that is ownership of property. Ownership of property. Now, this property just does not reflect or does not reflect just a piece of land. No. Anything that you can purchase and the transaction is final is your property. This could be land, this could be a car, this could be machinery, and also intellectual property, creations of the mind, patenting. When patents are granted, you have exclusive right to use something, and that is what is meant by property rights. Do you own it or does the community own it? Also, the other feature of capitalist economy is that it is based on market demand, not according to what people need. Now here, I would like to tell you a little snippet of history. The piece of history is this. You might have heard of USSR, or as we know of it today, Russia. USSR basically stands for Union of Soviet Socialist Republics. It was a group of 15 to 17 countries, and Russia was the key member, was the state that set up this union. Now in USSR, or even today, as you know, Russia and America, they are fighting. This fight is not about any piece of land or any sorts of resources. It is about an ideology. It is about this ideology or the conception of how society should be organized, how these economic problems that we have just seen, how they are supposed to be dealt with. In a capitalist economy, as we saw, let's write in place of capitalist economy, let's write the epitome of capitalist economy, that is America or United States of America. So here there will be property ownership. Property will be owned by private citizens. Private citizens are going to own property. But in USSR, government is the owner of means of production. All capital assets, all land belong to the government. And therefore, you will see that in such an economy which is not capitalist, production will happen not according to market demand, rather it will happen according to what the government thinks is necessary for society. This also tells us that this ideology will be focused more on welfare of the people, welfare of society as a whole, whereas America will be more focused on individual liberty. America, it focuses on individual liberty, whereas USSR, Russia today, or any other country that claims itself to be communist will focus on people's welfare. Now, there was one point that I mentioned in the beginning. Adam Smith said, as a moral philosopher, he said that greed is good. But if you think, even today, you might hear someone saying, Lalach buri bala hai, you should not be greedy. So the catch over here is the fact that there is another maxim associated with this, which is indispensable, which is necessary and sufficient to make it a sound moral philosophy. So greed is good. First, let us know why he said this. Adam Smith made the observation that when the baker, when the butcher, when they have surplus, when they make a profit, this profit they invest. And this investment, let's say you own one bakery and it generated a lot of profit. Now, in order to increase that profit, you are going to invest, open another bakery, and that is going to secure jobs for 10 new people, 20 new people. So this private profit, this phenomena of private profit leads to collective wealth. Collective wealth. That means in the process of one person getting rich, everyone is getting richer. And this is also sometimes termed as the trickle down effect. Trickle down effect. So you see, this is why Adam Smith said that capitalism or greed is good. It is good only as long as these profits are invested in order to increase production. Increased production, increased wealth distribution will lead to every person enjoying higher material success, higher material consumption. That means better quality of life. So the indispensable maxim that has to go with greed is good is the fact that that profit generated because of one person's greed must be invested to increase production. And therefore, we can come to another very important conclusion about capitalism, which will help clear your concept about why do we worry about this GDP growth. So capitalism assumes that there can be an ever increasing production. Ever increasing production. But if you think logically and if you see the problems that the world is facing today, you will soon realize that this is not entirely true. And this is what engenders certain other phenomena like Earth overshoot day. Currently, over 2.2 billion people in the world, they live below the poverty line. Below poverty line. That means if everybody wants a certain status of consumption, a certain amount of consumption, a certain level of material well-being, then we need we need another Earth, we need another planet, to fulfill the demand of everyone to reach the same material well-being. So this is the factor associated with capitalism. Now, socialist economy, we already know that government or the state owns means of production. Now, this USSR, this entity, it collapsed in the year 1991. And you can remember this as a rule of nature or the way the world works. I should not say nature, but the way the world works is that any crisis, any sort of revolution, fall of any empire is inherently related to an economic crisis, be it the French Revolution or be it fall of USSR. The primary, the underlying, the fundamental cause behind it is an economic problem. And as you can see, as I have mentioned, this absence of price signal is the fundamental cause why the economy collapsed. So there were phenomena like farmers used to pack rotten fruits with good fruits. And the reason was that they did not have any monetary incentive in order to do work more than what was given to them, more than what was required of them. The slogan that USSR gave was, from each according to his ability. That means the work you do, you'll be made to do the work that you are able to do, whereas you will get to each according to his need. So this is the reason USSR collapsed. If you try to see what the problem was, let's say this is the same problem that barter system faced before the beginning of modern world. Let's say there are fruit, then eggs, stationery, and shoes. So now, how many fruits do you have to give up in order to get eggs? How much fruit should you give in order to buy stationery? And how much fruit should you give in exchange for shoes? And similarly with every other product. So prices are basically signals of what you value. Value is a very subjective phenomena. You can value one thing and the other person might not value that thing. For you, a phone might be valuable. For the other person, a book might be valuable. So value is subjective, but the proxy, the way we measure how much one person measures values something is by the signal of money. How much money you are willing to spend on something is the signal, and that tells society, that tells producers what is to be produced. Let's take an example of a shoe. So a producer produced a very good quality of shoe and you are paying, let's say, 2000 rupees for it. So now the producer is getting something, you are getting something of value, and there is profit generated. The resources are allocated accordingly. But let's say that tomorrow that the quality goes down and the shoes are not so comfortable. So its price might come down, or the business might go, the production of shoes might go out of business. This will happen because people do not value that product anymore. It is not good enough to satisfy their want, to satisfy their need. That is why it will go out of production or face a loss. And it is this price mechanism that another important term associated with Adam Smith, one of the most famous words that come out of Wealth of Nation is invisible hand. Invisible hand, the hand that you do not see, but it works. It arranges things, it makes things go in motion and sets them right. So this invisible hand is nothing but the price signal that tells what you have to get, what you can get, and what you do not want. A restaurant that serves something for, let's say, one dish for 1000 rupees, you might not prefer it or you might prefer it, depends how much you value, how much purchasing power you possess. That is what the invisible hand is. You go outside a very big showroom and you do not enter it. There might not be any physical boundary restricting you from entering that showroom, but still, you do not enter it because of this invisible hand. The thing stopping you is this invisible hand of price signal. Now, one little question is in this regard. Now that we know about socialist and capitalist economy, a report called Survival of the Richest. I'll take 2 minutes and wait if any one of you can answer this question. Survival of the Richest report has been published by which organization? If you could answer, any one of you. So this Survival of the Richest report has been published by Oxfam. This is an NGO consisting of 21, a group of 21 other NGOs, and it works in the field of equality and poverty alleviation. This is the organization, and what it says in this report is that if you want the nation to be more prosperous, for people to be out of this phenomena of poverty, then you must tax the super rich. You can read this report. It has a variety of data regarding how bad the situation is. So, as I have already told you, you can take the example of water and petrol. Water, though it commands a price today, but not so high, not as much as petrol. The reason is its availability. It is available abundantly. That is the reason why water is not so expensive, whereas this petrol or any other petroleum product, it commands, it is expensive. The reason is availability, and that is the importance of prices. Prices are basically signals of how much something is available. So now let's come to these terms: GDP, NDP, GNP, NNP, and HDI. Now, before proceeding to tell you about these terms, let's first know about the difference between growth and development. So this growth, simply stated, is a quantitative measure. Quantitative measure. A good way to understand this would be, let's say you are sitting and dining, a group of 6, 7, 8, let's say 10 friends are sitting together and dining. Now, suddenly Bill Gates comes and sits with you. So the average salary, the average earning of everyone goes up. It will be in billions. But in reality, none of the 10 persons originally sitting, they would have been earning $1 billion or rupees, anything. So you see here, the quantitatively there was an increase in everybody's income, but qualitatively nobody could use it. And that is why we have this term of development, which reflects the quality of life that a nation or a country enjoys. So then, what does this term GDP stand for? GDP stands for gross domestic product, made of three words. Individually, gross simply means without adding or without accounting for losses or depreciation or obsolescence. Obsolescence, anything becomes obsolete when it is no longer required. Now, you can take the example of CD-ROMs. Nowadays, everything is digital, stored on the cloud. So these CD-ROMs, they are no longer useful. So it is an obsolete technology. CD-ROMs, floppy disk, Walkmans, even if India still has machinery that can produce these things, they are obsolete because they are no longer used, they are no longer in demand. Domestic means within the national boundary. Within the national boundary. Product, goods and services that are produced. So now, the key thing to focus here is we will see this D and this N. This N, the other N stands for this concept of netting or discounting for losses, depreciation, such kind of things. This domestic simply means what is being produced within your national boundaries. But the fact is that there are so many companies, multinational companies, let's say Philips or Facebook, the advertisements that Facebook carries out, the profits accrue to its parent company, which is not Indian, it is not sitting in India. So though it is happening within the boundary of the country, they actually leak out. There is leakage, it goes out, so that despite being part of the domestic production, it will not add to people's income, it will not add to national income. The government might charge some tax, but it will not become part of the production of done by people of India. So we understand that there is a difference between what is being produced within the country, because one country, any country nowadays, has this foreign direct investment. Foreign direct investment, that means nationals, citizens of other countries, they come, they invest in your country because your growth rate is good. As you might have seen in recent tweets, the G7 countries are growing by this much every year, whereas India is supposed to grow way beyond 7.5% per annum. Or this year's growth projection is at least 7.5%. So people would prefer that their money grows by this rate rather than this rate. So people from advanced economies, from developed economies, they would prefer to invest in India and therefore take a part of the profits, take a part of the production that happens in India to their own country. So naturally, we move to net national product. Net national product. So national is about citizens. You must have heard of this word, remittances. A lot of Indians, there is Indian community almost in all the advanced economies of the world, a thriving, successful community, and they send back money to India from whatever they earn outside. So this becomes part of people's disposable income, And therefore, national product, net national product, is not just about what is happening within the boundaries of your country, but rather it factors in production, income by all the citizens of a country. That is the concept of net or gross. Both of these, net and gross national product. It is about people earning that income, whereas GDP is about production taking place within a certain geographical boundary. We'll see what are the components of GDP and how it is measured. But let us also see this concept of HDI. HDI stands for Human Development Index. Index numbers, let's say this year, index number, how are they assigned? Let's say the GDP this year was 1 million rupees. Rupees 1 million. That was the GDP. That was the net value of all the goods and services produced in the economy, was 1 million. So now this 1 million will be assigned an index number of 100. And next year, if the GDP becomes 1.2 million, that means there is a 20% growth, right? That is the meaning of that is the meaning of an index number. Now, what this Human Development Index tries to measure, Human Development Index tries to measure, of course, you already know the meaning of this term, development. It is the quality of life, not just materially, but other factors also. So this measures basically three things: expected years of life, or we could call it life expectancy, expectancy at birth. At the time of independence, a person born during that time, during 1947 or up to 1950s, could expect to live only 32 years, because there were a lot of diseases, there was not enough health infrastructure in our country, so life expected years of living was so short. But today it stands at 67.7 years. Anyone born today can expect to lead a long and healthy life. The other thing is expected years of schooling, education. We want a society that is educated. Everyone has to behave according to the rules, according to laws, and that will happen only when there is education. That is a necessary condition, though not sufficient, but certainly this is a necessary condition. Today, this stands in India at well above 12. It is somewhere around 12.6 years. So any person born today, because of initiatives like Sarv Shiksha Abhiyan, right to education, it is a fundamental right under Article 21A of the Constitution. And therefore, anyone born today, irrespective of whether rich or poor, can expect to study 12 years or go to school for 12 years. And finally, we have per capita income. Per capita income or standard of living. How much money you earn, that decides how much material consumption you can make. And that is decided by per capita income. How do we arrive at per capita income? National income divided by population gives you per capita income. Now let us look at the components of this GDP. Few questions that can be asked in the exam is the organization that measures GDP. This organization is, so this GDP or gross domestic product, it can be measured in three different ways. One is the product or whatever is produced, product method. Then there is the income method and expenditure method. The first thing that I said was that any science or any study first tries to define certain things and then moves forward. So, in order to measure GDP, what we assume is that there are firms and there are households, individuals. Now, these firms provide certain goods and services. Goods and services are provided to households, for which the households give them money or spend some money. So, how much will the households be spending? Equivalent to how many goods and services, or the monetary value of these goods and services. These should be equivalent. And similarly, these households provide the factors of production: labor, land, capital that will come out of the savings of people, as well as entrepreneurship. Is being provided by the households, and in return, firms give them factor income. So this, as you see, this is the expenditure method, this is the product method, and this is the income method. All of them in an ideal scenario should come out to be equivalent. The other thing that gets involved is taxes and subsidies. Once there is government, taxes and subsidies. So now let us move ahead and see how this GDP, what all components it involves. In India, the organization that measures GDP is Central Statistical Organization. This itself is part of the Ministry of Statistics and Program Implementation. Another important thing to know is that the base year, the year for which index number 100 is assigned to the GDP value, is 2017-18. And when we say GDP, we mean GDP at market price. Market price. How do we arrive at GDP at market price? There are so many sectors of an economy. There is agriculture, industry, services, and in itself they are very much varied. So gross value added at factor cost is what was being measured initially. Today, when we say GDP, it means GVA at basic prices. GVA at basic prices, GVA at factor cost, and GDP at market price. These are the three terms. As of now, you might be feeling confused, but let's see what it entails. This GVA or gross value added, you must have heard that GST is a value added tax. So similarly, let's say wheat came in, entered a factory, and the output it gave is bread. So if this wheat was for 100 rupees, the wheat produced was worth 100 rupees, and this bread is worth 150 rupees. Total amount of total quantity of bread that would be produced is worth 150. Then very simply you can say that the value added is worth rupees 50, and this is what GST will be charged upon. Now this GVA, what are the components of it? Let us look at it. This GVA at factor cost will be compensation to employees plus operating surplus. That is, any business has a lot of inventory. It has to keep working capital, all of these things. Consumption of fixed capital or the machinery, the productive tools. You have to, with every cycle of use, they go on deteriorating, depreciating, wear and tear occurs, and that is why we factor in this consumption of fixed capital. This is what GVA at factor cost involves. Now let's move on to GVA at basic prices. This gross value added at basic prices. Initially, what we saw was cost. The moment price happens, the moment a good enters market, that means we can say that some sort of taxation will be involved. And this GVA at basic prices will involve GVA at factor cost plus production tax. Now this is an important point to focus on. There's a difference between production tax, production versus product tax. Production is a process. Product is the physical good, physical commodity. This process, so what will be production tax like? Excise duty. This is a production tax. Stamp duty. registration fees. These are not dependent upon the volume, the number of goods produced, rather they are only about the process going on, and therefore they are the production tax. But something like value added tax, this is applied on every single good or service and depends on the volume. So this becomes the product tax. Now, the only difference that is created between basic price, factor cost, and market price. Market price and factor price. Oh, factor cost and factor cost, market price, and basic price. Basic price will not involve production tax, will not involve the product tax. Product tax will not be involved. Whereas in market price, product tax will also be factored in. Hmm. This is a basic relationship between the different expressions of GVA and GDP. Value added versus product. At every stage, successive stage, let's say when when wheat entered the factory and became bread, then some value is added. This bread, when it becomes pizza, then further value is added, and only that level of value addition will be taxed. This is why GST is also called a progressive tax, because there is not a cascading effect of taxes. There is no cascading effect of taxes. That means tax is not being charged on tax. It is only being charged on the value added for that product. Now, certain other measures related to this, or first, this Human Development Index itself is published by the United Nations Development Program under the UNDP, or the report is called United Nations Development Program, and it is published every year under Human Development Report. The report published in 2023-24 places India on 134th position out of 193 countries. The score that India got is 0.644. So we are above 0.5, not too far behind. And even this number 134, it is closely contested because lot of other countries, even let's say any country that has this 0.643, that will be ahead of India. It has been topped by Switzerland, and Switzerland has a score of well above 0.9, 912 possibly. The report itself is titled Breaking the Grid Lock. This is the title of this Human Development Report 2023-24, Breaking the Gridlock. So these are certain questions. These are certain questions that can be asked in the exam regarding Human Development Index. Then certain other concepts related to now this thing, budget. Fiscal deficit, you will hear the term, and revenue deficit. So fiscal, this word fiscal comes from fisc, which means purse. Budget itself comes from the word baguette, which simply means a bag. So any policy that entails, let's say this is government's treasury and money coming in, how will there be inflow? Tax, fees, other service charges, that will lead to money coming in, and expenditure on welfare measures, on increasing the amount of capital stock that the country has, infrastructure. These things decide what is or how much is the deficit faced by the country. So taxation policies along with this expenditure policies make the fiscal policy of government, how much money it is planning to earn and how much it is planning to spend. If it is planning to spend more, then it becomes deficit, and if it is spending less than what it has earned, then it is in a surplus. This revenue deficit simply means revenue is that part of government's budget which is required for day-to-day operations. Day-to-day operations as against capital formation. Capital formation. So components like salaries, pensions, these things, they are not productive. Tomorrow they will not help you generate more money. But anything that helps you generate more money tomorrow, they form part of this capital assets, capital expenditure. And therefore, they will not come under this revenue expenditure, they will come under capital expenditure. So revenue deficit simply means whether whether the government needs money in order to finance its day-to-day activities. If this is too high, that means the government is in a problem, it is facing a crisis. It needs to borrow in order to, if you need to borrow in order to run your house, that means you are in crisis. And similar is the situation with government. So that is it for today. In the next class, we will continue with budget and see what are some of the other nuances involved in budget.